Welcome to the Wealth of Advice market update on the 11th of March 2022. Obviously, we bring this market update to you after a few weeks of the Russian invasion of Ukraine, and that's obviously had a very negative impact on pension funds and investment performance. So we're very aware that we have lots of clients who are quite concerned right now, and hopefully the content of this market update will allay some of those fears as we go through the various funds where clients are invested into, what's been causing markets to go down, and what some of the so-called experts in the fund industry are telling us might happen next. Matthew, Mike and Jordan were down in London last week for a two-day conference where collectively they saw around about 20 fund managers. We got a lot of information from those people and we're going to present that to you now. So we'll not dwell too much on the key headlines that you may have been seeing on a daily basis. Obviously there's some on the screen you can see now. It hasn't been good. The conflict started on the 24th of February and from there we've seen sort of consistent news stories on a daily basis about what the problems this may cause to the rest of the world, as well as obviously the humanitarian crisis that's going on in the Ukraine with what we're seeing on a daily basis of civilians, children being bombed and having to sort of flee the country. I suppose the biggest thing that's causing problems for markets all over the world is the fact that over the last 15-20 years, so many of the world economies and countries have become quite reliant on Russian oil and gas. BP, Shell, companies like that have started to say that they're going to come out of Russia and won't have an influence on the energy situation over there. But in the last few days as well, we've seen companies like McDonald's, Starbucks, IKEA, all these big international companies saying that they're going to close operations in Russia as world sanctions are really starting to bite. In the last 24 hours, you've seen Russian oligarch Roman Abramovich, who owns Chelsea Football Club, sanctioned. The football club's been put under the care of the government with lots of restrictions there. And all governments around the world are really starting to put the squeeze on these very wealthy Russians who have wealth dotted about all over the world. And what you're hoping there is that these sanctions are going to put more and more pressure on Mr. Putin, which may hopefully result in him sort of backing down from what he's doing. Whether that works out is we'll have to wait and see. The Russians are obviously trying to fight back, so to speak, in the sanctions situation, and a story that came through yesterday was that there is hundreds of aeroplanes sitting stranded in Russia because we've obviously got travel bans and we've got no-fly zones and such like going on in different parts of the world. So there's around about £12 billion worth of leased aircraft just sitting on runways in Russia. Because they are leased, you have to pay a monthly annual fee to the leasing company, and the Russians are now saying they might not pay those lease agreements, or one which I thought was quite funny when I read it, saying that they are going to make their monthly payments, but they're going to pay in rubles at the rate before the ruble crashed to its all-time low. So there's around about £12 billion worth of those leased agreements. I think there's a big company in Ireland which sits on a lot of those leases, which obviously just won't be getting paid right now, and a lot of these aircraft lease companies are just going to have to write off these planes in Russia. So that's their one way of kind of coming back. The next obviously big thing will be if Russia turned off its oil and gas supply to the west. This next chart you can see shows who the top 10 oil producers are in the world. United States is producing 16.5 million barrels a day. Saudi Arabia in second place, 11 million barrels a day, and then Russia comes in third. So what that looks like towards the end of the year, if Russia do turn off the tap, so to speak, how will that affect everyone in the rest of the world? The good thing for the UK is Russian oil only accounts for 8% of what we use. Our politicians need to get their finger out quite quickly and start looking at other places we can get our oil from. Go back to the North Sea, start getting it out of there. But total global demand for oil has been going up and up, although we are trying to use more renewables and such like. The demand for oil has been ever greater. The oil price has been going up recently, which has been causing all the inflation problems that we've seen in our country and around the world. But it is definitely worrying times as to what happens with the oil. The next big concern, apart from the oil, is the gas that Russia exports. And I think this is probably more important than the oil. As you can see on this chart here, Germany really has gone all in with Russia over the last 20 years. Angela Merkel now starting to get a bit of criticism for this. They were just about to turn on a new pipeline of gas from Russia before all this started, and that got suspended. But Germany still takes huge amounts of gas from Russia, and it accounts for around about 40% of the EU's natural gas supply. The UK only gets around about, I think it's around about 5% of its natural gas from Russia. The US doesn't import any Russian gas. So as I say, we might not be as badly affected as other countries in Europe, but that's not to say if those countries are badly affected, it won't affect us in some way. As a result of this, there's many sort of economists and analysts who are downgrading this year's growth for GDP expectations, which is not going to be good for markets. So if this continues on for the long term and we have a problem over energy, where we're going to get our gas from, where we're going to get our oil from, then that's where the major problems could come for the rest of the world. However, that said, on the back of this, everyone else around the world, the US, the UK, are now frantically looking at ways that they can solve this problem. And hopefully, as I say, in the next coming weeks, you'll see news coming through from politicians who are going to do something about this. And make no mistake, if in America we were reading that it's up to $4 for a gallon of petrol, this is a real vote loser for Biden. You've got the midterms coming up. He's going to want to do something to try and get the oil and gas prices down. Yesterday in the US, their inflation figures came out as being somewhere up to around 9%. Never seen those figures since the 1970s. So they really have to do something quite quickly to get this back down. Obviously, when we were doing these updates a few months ago, we were talking about what was happening as COVID was hopefully coming to an end and being in the rearview mirror. Inflation was coming back for lots of reasons. You now throw this into the mix, and that's why markets have reacted so negative recently. So what's happening in Russia right now? Well, as you can see from this chart here, the Russian ruble has collapsed. It's fell almost 30% since the financial sanctions were placed on Russia. The UK, the US and the EU have cut off all Russian banks. There was a big thing we saw recently of cutting them out of the SWIFT banking system, and then you saw Visa, MasterCard, American Express stop being allowing their cards to be used. So really, the Russians are becoming a pariah state where no one will deal with them. In the last 72 hours, the rating agency Fitch has said that the Russian government will probably default on its debt. Thankfully, the government bonds and corporate bond funds that we use won't have any Russian debt in there right now. I know the Legal and General Multi-Index last year had a very small percentage in Russian emerging market debt. That's been sold off. So none of our clients should be adversely affected by what's happening directly with this Russian ruble if they do default on the debt. Interestingly, Russia built up a bit of a war chest. It's been called in many newspapers and articles you've read of around about 630 billion in reserves. And as I say, I mean, you read this and you're saying Putin's this mad genius and he's built up this war chest if anything goes wrong. The problem he's got is the vast majority of it's being held in overseas banks, which have now been frozen from him. And as I say, what we're doing with all these oligarchs and frozen all their assets, you have to hope that inside Russia right now there's an argument going on with all of these billionaires who all of a sudden have been able to take a yacht here or take a private jet there, go and buy an apartment in New York, look after the mistress in Miami, that sort of lifestyle that they've lived for the last however many years. Well, all that's been cut off overnight. And if you think about on the streets of Russia right now, you're going to have the 20-somethings who are used to walking around with their mobile phone in their hand, going on Facebook, TikTok, going down the road for a Starbucks, getting a McDonald's. All that has been stopped to these people pretty quickly. The problem they have there, if they want to protest, they're going to get 15 years in jail. But you are seeing protests come through in some of the bigger cities. And again, we just have to hope that these sanctions will have the desired effect and put so much pressure on Mr. Putin that he does pull back, end this, and as I say, markets, if that happens, will hopefully recover. So we are keeping a good close eye on what's going on in Russia, what's happening with their currency and such like, because it's all important stuff. And you're seeing various news articles coming out saying we need to do this, we need to do that. People need to think through what the consequences are of everything that we're doing, and I think world governments are actually doing that with regards to the SWIFT banking system. Everyone was clamoring for it to happen kind of instantly. It was considered, it was thought about, and then a few days later it actually happened. So this next chart shows that as the Russian ruble collapsed, Russian central bank increased their interest rates, and this again is because inflation in Russia just went absolutely crazy. The price of food more than anything shooting up. So interest rates in Russia are now almost at 20%, and this is basically try and shore up the ruble, try and make people stop spending as much, leave money in the bank. But there's been a run on a lot of banks, people queuing around the block to get their money out. 20% interest rates, it shows you how much of a drastic action that they've taken to try and support the ruble. The Russian stock exchange closed on Monday the 20th of February, again in an attempt to limit further falls, but the Russian market was down by almost 60%. Again, just to allay any concerns our clients might have, we have never invested in the Russian stock market, and none of the funds that we invest into have any exposure to that. Over the years, there might have been the odd company here and there that a fund manager might have selected in like a global opportunities fund, something like that, but right now none of our clients would be exposed to that. We look at the currency graphs right now. There's no great surprise whenever there's a conflict or something bad going on in the world. The dollar is often considered the safe haven currency. So the fact that the pound and the euro are trading slightly lower than the dollar was to be expected. The pound is down to $1.31. I think it's going about €1.19. The euro to the dollar, that's again down slightly. These are not unusual, and if you look at the graphs, we're nowhere near the worst points which we saw over the COVID period. So as I said, a couple of the guys were down in London last week speaking to various fund managers. The mood down there was positive overall, in so much as although markets have fallen in recent weeks and they may continue to fall as this war rumbles on, there will be a turn, and markets they fully expect to recover because the underlying fundamentals of most economies around the world are still largely positive. And some of the key bullet points that we noted from the fund managers we spoke to were US unemployment is falling. It's currently 4%. This is good. It's continuing to reduce. The labour market remains strong. So again, think back to recessions in the past. COVID was regarded as the biggest recession we were ever going to have, but there is jobs out there, there's opportunities. The outlook for consumer spending remains good, both in the US, in the UK and in Europe. People who have money are spending money. As I say, I'm talking to clients obviously on a daily basis, doing annual reviews and such like, and people as a result of the conflict are not suddenly going into their shell and saying, right, we're not going to spend any money because we're worried about what the future holds. By and large, people saved a lot of money during the pandemic and still are looking to spend that. Central banks around the world were planning on raising interest rates slightly during 2022 to control the inflation that we had coming through anyway. That's likely to continue. A few of the fund managers did say that they were expecting inflation to kind of reach a peak March, April, May and then reduce because inflation is a 12-month calculation. So February 2022's figures is based on the increase from February 2021, March 22 from March 21 and so on. They were expecting that inflation figure to start going down, but with everything that's gone on in Russia in the last few weeks, the spike in the oil price, commodity prices, etc. going through the roof, then inflation is likely to continue into the second half of this year. And the long-term view is that inflation is likely to slow down in the medium to long run because supply chains are being resolved. Again, think back to the updates that we were doing in October, November. We were hearing stories, for example, that Nike couldn't get enough shoes made in their factories in Indonesia and such like. It was difficult for us to import various goods into the UK from around the world. Well, that has started to become resolved. If you go looking around the world where these factories were having shortages of labour and such like, I mean, going about that top point of the US, unemployment now coming down and there's jobs being fulfilled. This is all good for the inflation story. So overall, and I know you can't just detach the war from what's happening in the world, but if you detach that from it and look at the underlying fundamentals, there are good stories to be had. Again, on the next update we're going to do, which we'll put more details of this into the email we're going to send with this update. On the 24th of March, we're planning on doing a live client market update to give clients watching the opportunity to ask any questions that they may have back. The 24th of March will obviously be exactly 1 month on from when Russia invaded Ukraine. And hopefully by then the picture will be more clear as to what's happening in world markets. And one of the things that we are working on right now, which we're going to bring on that presentation, is a list of all of the main companies that each of the main funds we invest into do invest into. And I was looking at this yesterday, and the top 10 holdings for most companies are littered with names of companies who have got good, strong balance sheets, who are doing very well. Yes, when we mentioned that McDonald's and Starbucks and IKEA are pulling out of Russia, that will have a negative impact in the short term. Apple as well stopped selling their products there, but by the end of this year, Apple releases its iPhone 14 or whatever up to now, there will be a flood of people looking to go out and do that, and people are still willing to spend and buy products. So overall, as I say, the fund managers we spoke to have said yes, the outlook for growth in this year might have been, 5% for UK GDP. They're going to rein that back in to say only be 3% maybe, but it's still positive and it's higher than what it was pre-COVID. So we now come to the part of the presentation where we're going to show how markets have performed over recent time periods. As you'd be assuming correctly, some of the graphs and charts aren't good viewing, but we're going to show them all the same. The first one shows how stock markets have performed since January the 1st. If you look there, the pink line that goes all the way to the bottom is how the Russian stock markets performed. Thankfully, we don't invest in that, and that's why we've put it on there, just to show things could always be a hell of a lot worse. The Russian market, as we say, is down 64% year to date. The FTSE 100 is one of the better performing markets since January the 1st, minus 5.45. Again, the FTSE is stocked full of oil companies, which have performed very well recently. And then lines B and C is the MSCI World Index and the S&P 500 in America, and they're down between 9.5%, sorry, and 10.37%. So it hasn't been a good start to the year at all. We then look at that stretching back over a 6-month period, and you can see if we go all the way back to just before October, markets were rising towards the end of November, and then everything kind of came to a head. We had the Omicron variant reaching the press, and there was fears over more lockdowns around the world. We had the rise in inflation figures and such like, and then from January onwards, the markets have gone down, obviously on the fear that war was going to happen. Early February, markets recovered a little bit, as you can see there, and then obviously from February the 24th, bang, went down. And again, February 24th, I guess, is going to be that date that we're going to look back on when we look at this later months down the line, is the point when the markets fell off a cliff edge. I mean, that blue line at the top there, which is the FTSE 100, you can see it looks similar to the line you remember when we were talking about COVID, which when we now look at these index figures going back 5 years, that COVID line, when we were saying, has disappeared. Now we're well above that. We are still higher than where we were in February 2020, but the falls that have been seen in recent weeks have been quite severe. But also, I mean, the purpose of putting the 5-year graph in, we do have a good number of clients who became clients in the last 12 months. Those people won't have seen 5 years returns. A lot of people are saying, well, all we've seen since we became clients in the last 3-6 months is the markets to go down. When we look at this graph and say, look, if you invest over the last 5 years, the MSCI World Index, the FTSE 100, the S&P 500 has all still made money over that last 5-year period, even taking into consideration COVID and now this war in the Ukraine. The next chart, the VIX index, which many of our longer term clients will have been familiar with seeing. For those newer clients watching this for the first times, you'll see that this chart, the red line going across it, is an index which measures risk, volatility index, which abbreviates the VIX index. You can see there how the line spiked right the way up in February and March 2020 to the highest it's ever been in history as COVID came along and the world went into lockdown. Risk then reduced back down, and we almost got back to sort of normal levels, if you like, from April 21 through to October 21 there. Yes, it was bouncing up a little bit, but if you look at the line prior to February 2020, it was well within range that you would have seen in normal times. Even with the conflict that's been going on in Russia, that yes, the line has gone up at the end there where you can see the A on the end, but it's still not that much above where it was in the end of 2018, which was when Donald Trump was really ratcheting up his trade wars with China. So from a risk point of view, markets are riskier right now, obviously, but they're nowhere near the levels they were when COVID hit. Next chart is something we pinched from Schroders when we saw them speak at the event in London last week, and we just thought it was a great chart to put in for you all to look at today. And it shows how markets have performed when the VIX index has been around the current level or even higher. And as you can see, over the various time periods, volatility will often deliver high returns as a result of maintaining a long-term investment in these markets. So when people say, right, I'm fearful, markets are really risky, I want to sell, as you can see from this graph here, that the 12-month performance of the S&P based after various sort of risky times, if you like, has been quite spectacular in many cases. And you can see often double-digit returns being delivered as a result of staying in the market after these market falls have happened. And that's certainly what we're recommending clients to do right now. Yes, your funds have fallen over the last 6 months, more so in the last 6 weeks, but if you stick with it, there will be a bottom point and the markets will recover and bounce back from there. This next chart was quite surprising when I saw it. Again, it's something that we took from the seminar the guys were at last week. It shows how many times markets have fallen by more than 10% in a 12-month period, and you might be surprised to see that it happens more often than you would believe, actually more years than it doesn't, but long returns always remain strong. Over the last decade, markets have fallen by more than 10% in 2012, 2015, 16, 18 and 20. And despite these regular bumps along the way, markets will recover. The US market, for instance, has averaged 11% growth a year after these falls over the last 50 years. Short-term losses are always very risky and don't feel very good, but it's the long-term gains that will deliver, which again we keep repeating on these updates. But as I say, if you look at those blue drawdown lines there, going back to, I mean, I wasn't around in 1974, but you go down there, it was almost 40% falls. 1986 was 35%. 2002, obviously following on from 9/11, there was big falls there. Then we had the huge ones in 2008 with the financial crash, and then obviously what happened in 2020. And in all those time periods when those falls were suffered, markets recovered in pretty quick time thereafter. I think the 2008 financial crash was the longest one to recover from top to bottom, but most other ones, I think we'd said on a previous market update, take normally around about 4 months to recover from when we reach the bottom of the market. Obviously the problem we have with this current situation is we don't know when the bottom of the market's going to be reached. So earlier there we looked at how various market indexes have performed over various time periods. We're now going to look at how the Wealth of Advice risk scores and the Royal London portfolios, the most common portfolios we recommend to clients, perform. For any clients who aren't invested in these particular portfolios, everything that we recommend is pretty much similar across the board, in so much as the various risk categories will have a percentage in stocks and shares, a percentage in government and corporate bonds, a little bit in cash, sometimes there may be a little bit of property in there, and depending on what your attitude to risk is will dictate which portfolio you go into. So when we look at this, as I say, you can see over a 5-year period, those clients who took the most risk with risk score 5 have been rewarded the most. But if you go back to when the market started to fall, that will have certainly fell the most in the recent weeks. Over the last 5 years, we can see that the risk score 3 portfolio, which the vast majority of our clients are invested into, is still up over 25%. The risk score 2 portfolio, which is roughly 40% in the stock market, 60% in government and corporate bonds, is still up over 20%. So that's 4% a year net of charges over the last 5 years, with what has to be regarded as 2 quite catastrophic events there. You've got obviously COVID in February, March of 2020, and now this war situation that we've got going on now. So, but over a long period, you will be rewarded for remaining invested. The Royal London portfolios, we've got a cross-section of Royal London portfolios there. Again, these 4 that we've listed are the most common portfolios that we use. Their returns are listed there. The Royal London ones in the recent weeks, you will notice, haven't fallen as much as some of the ones with more stocks and shares in. Again, that's because they're more cautious, they have more government and corporate bonds, so they've been shielded by some of the falls that some of the ones with the highest stocks and shares contents have seen. These next 2 charts, something a lot of clients have shown interest in as we started doing them going back to February 2020, and this is how a notional £100,000 invested into the various portfolios that we manage has performed since then. Again, repeating what we explained over this 2-year period, February into March 2020, markets fell quite heavily. If you had £100,000 invested on the February the 18th, 2020, when COVID was really brought to the world news and markets started to fall, most portfolios fell by almost 20% in the space of 3 weeks. Things recovered by the October, November of that year. portfolios had recovered and we're back in positive territory. Thankfully, we are still in positive territory for that notional 100,000 going back to February 2020. But as you can see, the peak was about 119,000. That notional 100,000 had got to as we got into November 2021, and a lot of those gains have been given back. But for the vast majority of clients who have been invested over this long-term time period, whether it be in our model portfolios or the Royal London portfolios, you're still in a profitable position going back to the beginning of COVID. Again, we just have to hope that the bottom of this current downturn is not too far away and things recover like they did after the COVID dip. And as I say, everything we've said so far in the presentation, all the experts who were talking to us are saying that the underlying fundamentals of companies who we invest into, whether it be through wealth of advice model portfolios, Royal London portfolios, Prudential, HSBC, whichever contract that we have you invested into, the underlying companies and fundamentals of those companies are very well. And hopefully, as I say, things do recover. The oil price, the energy crisis is dissipated, and we can move on from this. I know there was a lot of content in this one, but as you can appreciate, there was a lot to get through. We are going to do a Wealth of Advice live market update on the 24th of March, which is a Thursday. We'll send instructions across on how to join that on the email. It'll be a link that you click. And obviously the reason why we're doing that one live is so that clients can ask questions directly. And hopefully we'll be able to answer on that day. And there'll be me, Mike, Matthew and Jordan available to answer those questions on that day. We're going to continue speaking with various fund managers in the coming days. Jordan's in the room behind me right now, and he's already speaking with various bond fund managers about certain things. And again, just to reassure clients, there's no funds that we invest you into right now that we want to get rid of. We're happy with how they're invested. We're happy with the various fund managers. That story that we had earlier on in the presentation about the Russian airlines not paying the lease agreements, and that's going to cost 12 billion to those leasing companies. We did have a fund over 2 years ago that we invested clients into that invested in these sorts of things. We got rid of that fund for COVID reasons, for the people not travelling and such like, so we don't have any of that in the portfolio. So we are constantly monitoring these funds and portfolios to make sure there's nothing kind of naughty in there that we want to get rid of, and right now we don't think there is. The markets may continue to fall in the coming days and weeks, but again, please just stick with it. And as I said, there will be a point when markets turn and markets recover. So without further ado, thanks for listening. And if you have any queries, problems or questions, just get in touch through the usual channels. Thank you.